We're just going to give it a minute for everybody to join. Thanks, everybody. All right, let's kick this off. So thanks to everybody who has joined us today for a chat with management team of WULF. Before I introduce the team, I just want to say if you would like to ask a question, you can submit a question through the Q&A box you see at the bottom of the kind of Zoom window, or you can shoot me an email at brett.knobloch@cantor.com. With us today is Paul Prager, co-founder and chairman and CEO, Nazar Khan, co-founder and CTO, Kerri Langlais, CSO, Patrick Fleury, CFO, and John Larkin, director of investor relations. Primary focus of today's call is going to be the deal WULF announced, I guess, 2 weeks ago with Core42. So I guess to start, maybe a question we received a lot is just on who is Core42, and of all the interested parties that I think you guys entertained throughout the last several months, why did you choose to go with them?
I mean, I'll feel that. Hey, listen, because they're world class. Core42 is a totally owned, wholly owned subsidiary of G42. They specialize in sovereign cloud, AI infrastructure, digital services. G42, most people should know the name. I mean, they've been a lot of the press recently, but they're a sovereign wealth fund of Abu Dhabi. They're a global leader in AI. They have very strong financial backing from Mubadala, Microsoft, Silver Lake, and others. We said day one that we were going to pick someone on the basis of financial credibility, their strategic vision, and culture. And by culture, I mean, their alignment of their AI and data center goals with that of TeraWulf. These guys check every box, and they're best in class from a partner perspective, and they provide tremendous financial credibility and space credibility in high performance computing and AI.
Now, is it safe to say that the credit quality of this customer is near, if not better than many of the hyperscalers, kind of given the government backing, plus it was somewhat vetted by the US government in order for Microsoft to invest in them?
100%. I'm glad you asked the question because sometimes you read online some of the concerns, and people were talking about financial credibility. Why didn't they go with the hyperscaler? Given their sovereign backing and their private investments, they are at least on par with the hyperscalers in terms of creditworthiness. And don't forget, we hired JP Morgan and Morgan Stanley to advise us, along with Milbank from the legal side, to advise us as we were going down this path. These guys are eminently financeable. They enable us to do what we need to do, which of course enables them to do what they need to do, bring the units and get that compute time going. So world-class credit.
Okay. I think a lot of investors have kind of been comparing this deal to the only other deal announced in the space, which is the one with Core Scientific and CoreWeave. Initial revenue per megawatt is similar, but I guess they have the benefit of CoreWeave paying for majority of the CapEx. Now you guys are quite clear that CapEx side of the equation wasn't going to be replicated. But could you maybe go into more detail on how you arrived at the lease terms that you guys have disclosed, and maybe for those who might not be familiar, just kind of walk through those lease terms as well?
Yeah, hey Brett, I'll handle that. And I apologize, I'm in an airport, so if you see people walking behind me, sorry about that. But Yeah, look, I don't know all the details of Core Scientific's deal, but what I can tell you is our deal is a very good deal for our shareholders. So as we've kind of laid out, it's 1.5 million of revenue per megawatt. Our build cost will be likely around 5 million per megawatt, and that's a gross number. When you adjust for PUE on this 72.5 megawatts of PUE is about 1.2. So that's a net 6 million per megawatt for critical load build and 1.5 million of revenue per megawatt at a 70% EBITDA margin is just over a million. So it's like 1.05. If you divide that by 6, that is a high teens return. And that is, once we lever that, that is a high to mid 20s. And one point I want to make that I know is different in our deal versus Core Scientific's deal is we have an annual inflation adder. So that means that's where we start from a yield perspective. But if we can keep that 70% margin in line and not have increase in costs, which I'm very confident we can do, then both the unlevered and levered yield increases annually. So 5 years in, it is a much higher yield than the initial sort of high teens start, if that makes sense.
Then just on the price ranges, I think, it's hard to compare apples to apples just because I think there is a big difference in credit quality. And I know earlier on, when you guys first started to talk about this roadmap, going with a hyperscaler, they were offering kind of lower rates. I guess the way that I'm kind of thinking about this is you're getting economics very similar to what Core's is getting with a much higher credit quality customer. Is that a good way to think about it? And then just the
Yeah,
ranges of maybe revenue terms that you were in discussions with from various partners, like where does this fit amongst all the conversations you had?
yeah, sure. Like I said, I think it's hard to compare this to Core because again, I don't really know how Core Scientific's CapEx works. I don't know who's funding what, whatever. So what I know for us is we have committed from day one that we would get a 1-year revenue prepay, which would be about 30% of the build cost, and then we would finance the other 70% in the project finance markets. We have been unwavering on those points, as equally unwavering as we have been as it will not be a hyperscaler. So I think when people ask, Brett, or even when I see other management teams in the space or those that are trying to get into the space talk about revenue, it is nonsense if you don't talk about build cost. In other words, you could earn $3, $4, $5 million per megawatt, but if your build cost is $10, $20, $30 a megawatt, then again, you just can't talk about the two. It'd be like talking about Bitcoin without talking about network hash rate, right? You can't do it. So again, we think about it as yield on our CapEx. And not only that, we think about it as unlevered yield and levered yield. And so, look, there's a lot of other folks that competed for our capacity that were very competitive. And we've got a lot more capacity to sell, both at this site and other sites. And so, I think you'll continue to see us win.
Awesome, Matt.
But
That's very helpful.
I would just want to add to that. I mean, there's a big spread between 9% unlevered return and 17% unlevered return. And we ended up at the high end of the return profile with the high end of the credit quality. So I think, and not by accident. Again, the teams were deliberate, they were diligent, and we're delighted with our contracting party and the terms of the deal.
Yeah. Maybe just jump into a kind of a user submitted question here. Curious on the visibility contract agreement on who Core42 customers or end users will be within the Lake Mariner site.
Paul, I can answer part of that. So look, I think as Paul mentioned, we retained JP Morgan, Morgan Stanley, Millbank. We're working on a project financing. I think as we've indicated publicly, that will likely be done around mid-year. And I think during that process, we'll probably be at a juncture to kind of explain who are the counterparties behind our tenant. But that's really not for us, Brett. That's really for our tenant. And so, I don't want to steal their thunder. I think they will become a much better well-known entity in the US over the next sort of 3 to 6 months. And folks will understand who their customers are. But I would just say I think it's a similar business model to CoreWeave in that they have a use for a certain amount of capacity. The financial backers of them have a use for a certain amount of capacity, and then they also have a number of very large enterprise customers. I don't know, Nazar, if you want to add anything there.
No, as you said, the customer base we'll roll that out in a couple quarters here. The Core42 is actively engaged in a number of discussions, and part of the option that they have at the site feeds into the visibility they're seeing with respect to the ability to add customers over the course of the year as well. So the initial capacity that we've signed with them, the 60 megawatts of critical IT load, represents things that are in hand or close in hand, and then again the 108 megawatt option that we provided to them was geared around their visibility on what they thought they could kind of add to over the course of the year as well. So yeah, as Patrick said, we'll kind of provide some more details here in the near future on specifically who those counterparties are. But again, it's a lot of enterprise type customers.
Perfect. And then I guess speaking on that option, is there an expiration date of that option? If so, when? And then I guess, is there also the potential for them to come back to you and ultimately take on additional capacity beyond that option? Or is that really just dependent on kind of like the demand they're seeing on their end for compute?
Absolutely. I mean, I think an important factor in selecting G42, Core42 was their ability to really scale. And so these first 60 megawatts of critical IT and then 108 megawatt critical IT load option are really more centered around what is their immediate needs and kind of their near-term needs that they see in their pipeline. They, could grow to, we expect them to grow fairly significantly, much in excess of those two amounts. And again, that was a very important factor in the selection of them as a counterparty, is they have the ability to really scale and grow very quickly. So the existing option that they have, they need to inform us by March 31st, which is, kind of, this quarter here. And a lot of that is predicated on our ability to deliver the capacity. And so it takes us, kind of 9 to 12 months to turn, from the time we start to the time we bring a data center building online. And so a lot of that timing, again, is dependent upon our ability to deliver, to their customers. So as I said earlier, that 108 megawatts is the visibility that they currently have in customers they're seeing towards the end of the year, early next year, in terms of being able to add that capacity.
And if they exercise that option, call it March 31st, when would you guys begin to kind of break ground on the next buildings that would be associated with that option?
April 1st.
Back half April. Okay. Helpful. And maybe just another question on timing. I guess for the first, 72 and a half, will there be different periods of when revenue rec will start for, call it the 2.5 megawatt building, the 20 megawatt building, and the 50 megawatt building? Like, when will they all kind of start?
You're on mute, Patrick.
Sorry. When the buildings are done, we provide a sort of what I would call a commissioning report. I'm sure Nazar has the exact name for it, but in my finance terms, I call it a commissioning report. And that indicates completion and readiness for the building. And that's when revenue recognition begins. And so, that will likely be here. And look, I think we obviously try to coordinate that with our customer as well. We don't want to issue a commissioning report, months ahead of when they're going to have GPUs ready to plug in, right? This is a partnership. So I think generally speaking, the loose guidelines for that are likely, at some point here in January, if not early February for WULF, then in the sort of April, May timeframe for CB1, which is 20 megawatts gross, and then CB2 will be really split into 2 different data halls. That building's 50 megawatts gross. So the first phase of that, what we're calling CB2A, will likely be kind of July, and then the second phase will be October. So those are the rough estimates right now, Brett. And look, we may be earlier, we may be a little bit later. Again, that's just a coordination effort with our customer.
Great. And then maybe a question for Paul, just on Lake Mariner's kind of power capacity. I think you guys have 250 now. You're about to get an additional 250, and then I think your expectations to hop in the queue for another 250, and Lake Mariner can ultimately get to 750. I guess what should we think about timing for Lake Mariner reaching full 750 megawatts? Is that something that we could expect, by end of next year, or how should we think about just the progression of Lake Mariner's capacity increasing?
I think the answer is yes, but we're very sensitive to the needs of the customer. We will scale as our customers require us to. And I say customers because while I think we're prepared to have Core42 and G42 have as much capacity as they wish, we're likely to end up with another customer. And ideally, we'd end up with 2 or 3, certainly not more than that. And then, the question is, what do we do with the Bitcoin mining? At this time, we've told the world that we're happy to continue to mine up until certainly the next halving, when we'd have to make some decision, because it would be a natural time to invest in more mining equipment, or make the decision to go ahead and convert that space to HPC AI. And I think that is currently our inclination, because it's the highest value for the megawatts.
Now, I guess next halvings, call it, just over 3 years away.
Yeah, and we look at it, we've told the world, in all of our discussions here, that we think it will take us 3 to 5 years to build out this entire capacity.
But Brett, just if I may, just to also put a finer point on Paul's last comment, right? We are very economically driven. As you know, our management team, board insiders own, I think, upwards of 30% of the equity of the company, right? And so when we look at the unit economics for Bitcoin mining and high power compute, right, just high level, if you take 1.5 million per megawatt of revenue, that is equivalent to approximately $150 a megawatt hour, right? So let's put everything in megawatt hour terms. We're making a 70% EBITDA margin. And by the way, just to clarify, that's 70% EBITDA margin, because I know one of our peers, is guiding to 80%. That 70% for us also includes maintenance CapEx. So I know I've labeled that in past presentations as EBITDA margin. It's really cash available for debt service. And because we are not a taxpayer for the next 3 to 4 years, given our NOLs and deferred tax assets, really all we have is principal and interest after that figure. So I know that I'm commingling things, but back to the point, $150 a megawatt hour at a 70% margin, right, is $100 a megawatt hour of effectively cash available for debt service. Bitcoin mining, right, is today, if you converted, hash price into dollar per megawatt hour, and it obviously depends on what machine. So let's just take an S21. Today, that's about $110 a megawatt hour. And so, our energy is, call it 40, 50, and then you have other costs. So we're literally making 2x the margin in high power compute and AI with no volatility and a 10 to 20 year contract. So I just think those are really important takeaways for people as we kind of introduce this new business line. And that's candidly why data centers trade at much higher multiples than Bitcoin miners.
And again, just to go back to the schedule, if the halving is going to be in 3.5 years, we think we build out 500 megawatts of high-speed compute AI over that same period, basically 100 to 150 megawatts a year. So we have time before we have to make a decision regarding the Bitcoin mining, which would then extend, if we wanted to convert those spaces and that power over to high-speed compute or AI.
Do you think it's likely, though, that before we reach the halving, that, given Lake Mariner is a, tier 1 asset, that the power being used for Bitcoin mining there will be in demand, more so that would maybe accelerate when that could get converted?
I think Patrick just sort of answered your question in the sense that we're making a lot, we get a better return here on our megawatt value in this new business. And therefore, it's a natural extension of what we've always done, seeking the highest dollars and highest returns for our electricity infrastructure. It is possible that we will be presented with having to make that kind of a decision. And we'll make it at the time. In the meantime, we have 500 megawatts that we could provide customers to, and additional sites with available power. But it is possible because the need for infrastructure and energy for high performance compute and AI is massive.
I guess one thing, Brett, to add on to that, that's not necessarily in the profitability metrics that Patrick mentioned, is the value we see inherent in having the Bitcoin mining load on site while we start to rapidly scale the HPC and AI. Today, we participate in 3 demand response programs in the New York ISO and Zone A. And so, you know, as you start to deploy these 100, 200, 300 megawatt loads that have very little flexibility today, that should change over time, hopefully with advancements. I think it's going to be very valuable to be able to also have in your toolkit a load that's probably the most flexible load there is. And so that will come and factor into, you know, whether it's profitability, demand, valuation, all those sort of things, that will also factor into our decision making.
When thinking about kind of like what's next with the capacity at Lake Mariner, you know, I think 178 available, of which 135 is in the option, giving you, you know, kind of 43, you know, near term available capacity. Would you think that's kind of big enough for, you know, the size of customer that you're looking for to start out with? Like, how should we think about a customer taking 43 with an option to add, you know, an additional 100? Is that initial 43 kind of big enough?
Yeah, I mean, I think so, right? I think it's also important to just take a step back, and you know, the Blackwell chip is not deployed at scale anywhere in the world today. Not by Microsoft, not by Amazon, not by anybody, because NVIDIA actually has to ship that chip today. And so as we think about kind of the growth and evolution of the market, you know, the latter half of 25, you know, we'll start to see, you know, kind of those chips, you know, be installed and operational. And so it's going to be, there's going to be a curve associated with kind of the growth. And so when you talk to customers who want 300-400 megawatts of power, they're not putting up 300 or 400 megawatts of GPUs in 12 months. You know, they themselves have kind of a 2 or 3 year ramp associated with it. So when we talk about these near-term figures, that's the near term of what we could deliver, which is, you know, again, in my mind, 40 megawatts is a decent chunk. And then behind that, we do have the ability to deliver hundreds of megawatts behind that. So all of the discussions that we're having, again, are very focused on, what's the real and credible and true near-term capacity we can deliver. And if you think about even a 40 megawatt deployment, you know, you're talking about, you know, $1.5 billion, $2 billion of hardware CapEx. I mean, these are not insignificant projects, even at, you know, 40 megawatts of size. And so, yeah, I mean, I think the discussions we have are, you know, again, squarely centered around what can we do now with, you know, again, our ability to feed into those much larger numbers, you know, over time. And, you know, as Paul mentioned earlier, you know, our base case is somewhere around 100 to 150 megawatts per year that we know we can kind of both contract for, given the discussions we're having with, you know, customers, including Core42, as well as what we're seeing in the market, and then also our ability to procure all of the equipment required to build these facilities. So, I mean, you know, there's a whole procurement chain that needs to start. You know, when we talk about this 9 to 12 months of delivery, you know, there's 2 to 3 months on the front end around design, engineering, procurement that feeds into that overall schedule. So when you start to factor all these things together, you know, I think it's unlikely that even if someone says they want 400 megawatts, that they're actually going to deploy 400 megawatts of capacity in the next 12 months.
On, I guess, the in addition to Lake Mariner, as you're thinking about, you know, again, like what's next, you know, Lake Cayuga kind of gets mentioned a lot. And I think in your December update, you guys mentioned looking at, you know, other strategically, you know, interesting sites for you guys. You know, how should we think about you guys looking to grow, you know, outside of Lake Mariner, whether it be Lake Cayuga or additional kind of bolt-on sites? And would that continue to be in New York? Would you expand into other markets? Or would it be kind of Lake Cayuga first, and then we'll see what's out there after that?
I guess I'll jump on that grenade. Somebody else can jump in after me. But look, no, I think Cayuga is a great site. You know, it's owned by the private company. It has all the same attributes as Lake Mariner. It's just a little smaller. And I think, those that are familiar with the New York ISO queue, if you pull the queue or if you email us and ask us, we'll send you a link as to where you can pull it. You can see our interconnect requests for both Lake Mariner and Cayuga. And Cayuga, I think, could be, upwards of 200, 250 additional megawatts. And so as you think about the cadence of our growth at Lake Mariner, it may make sense to, add that site in to the public company at some point. And again, that would follow the same exact methodology as the lease extension did at Lake Mariner, given that that site is in the private company. So independent committee of the board, independent financial advisors, legal counsel, all those things. So yeah, that certainly is top of mind, and as customer demand increases, that certainly is a possibility. I don't know if Kerri, Paul, or Nazar, you want to add anything?
No, go ahead,
Go
Bob.
ahead, Kerri. No,
I was
go
just
ahead.
gonna, I'll go quick. I was just gonna say, as it relates to sites other than Cayuga, right? I think Cayuga is a natural expectation for the next step for TeraWulf, given the affiliation with the private company. But we are constantly evaluating other sites that may fit sort of the criteria that we look at. I think, one of the benefits of our team being power experts and, building, operating, owning massive infrastructure sites is the ability to sort of suss out pretty quickly whether a site is going to be advantageous for build out or not. So there's no shortage, if you will, of the pipeline that people look towards in terms of future scale out. But I just wanted to mention that in terms of things outside of Cayuga, because I know everyone's very focused on Cayuga as the next opportunity.
Yeah, all that I was going to say, and I think it's a little bit redundant given the contribution by Patrick and Kerri, is, listen, Cayuga is owned beneficially by me. The most important element in my life right now is getting TeraWulf to provide a great return to our shareholders, of which the management team very significant. So at the appropriate time, and if the customers are there, Cayuga is a natural. The genesis of this team was development of energy infrastructure. We've done 5 gigs of power. I think we are the only team out there in Bitcoin miner / data center high-speed compute development that the professionals on the management team actually did power facility development over the course of the last 25, 30 years. And we've done it the last 15, 20 years together. So I think finding new spots, especially given how intimately familiar we are with our customers' needs and what they're searching for in terms of capacity, geographic diversity, power source diversity, I think we're the huckleberry for that. So, I'm entirely constructive on our ability to continue to grow at the rate that we have and accelerate if needs be.
Jump into a user submitted question here. What about the long-term ability to take Lake Mariner higher than 750 megawatts? Wasn't it originally planned to be north of a 1 gigawatt dual coal plant? Paul, maybe that one for you.
Nazar.
Or Nazar.
Sure. When it was, originally envisioned, there was going to be a sister plant to the 700 megawatt coal plant that we retired. So that was, kind of the target. The substation there, could probably do, a little bit north of a gig. It's a possibility. If you think about the evolution of the grid, the grid operator needs to constantly balance demand and then also supply. And so, we've been very clear in our applications, and part of the reason we've been able to efficiently procure the increase in capacity for our loads has been that we've been very clear on how much power we're going to use and the timeline in which we're going to use it on. And so if you kind of generally read the press today, a big conundrum that utilities are facing is how much they build for, these big numbers that people are talking about in terms of overall demand. And so it's a possibility. I think, we're very comfortable and we've got it and said, hey, we're going to get to 750. Could we do something more than that? Maybe, but we want to, kind of get through that first, 500-600 before we start to talk about, what's a possibility. And again, it'll be dependent upon what's happening on the grid. We happen to sit on the 345 kV line, which is the highest voltage transmission line in the state of New York. There's a tremendous amount of power flowing by our front door every day. So it would lead to the possibility that that's the case. But again, I think, we're very focused on getting to that 750. And then, we think there could be a possibility for more in the future.
When you guys renegotiated the lease and added additional land, I think it kind of brought to the point where you need a lot of land to kind of do, AI HPC. I guess, how should we think about acreage required for HPC data centers? Is there like a megawatt per acre type of metric we should think about? Or is it also possible to kind of, build more vertically to kind of increase the megawatt density?
Guys, you want to start and I'll go next? I mean, it's all land isn't created equal, right? It depends on the site, the average temperature, access to water, how much water will affect density. But Naz?
Yeah, I mean, at Lake Mariner, we've got the land needed to build out. I think, the addition was sized for us to kind of meet the needs for 750 megawatts as a single story deployments. So we're comfortable, at Lake Mariner to be able to do that. As we look at other sites, in areas that are constrained with land, you are seeing vertical data halls, that kind of sit on top of one another. And also you're seeing kind of, that concept, where people are running much larger kind of LLM training models where they want, kind of a proximity to be even closer than the distance of a building. But so far for the applications that we've been engaged with our customers on, there hasn't been a need to kind of go vertical. And again, we've got the space at the sites that we have, and that, is applicable to both, Lake Mariner as well as, the site at Cayuga.
Then on the CapEx build out costs, I think you guys are talking about 6 million megawatt now. Is that something you expect to stay somewhat consistent as you continue to build out Lake Mariner?
I mean, I'll answer that one. So, we've been really transparent, Brett, as you know, and given you guys a slide, and all the investors out there, pre-Core Scientific announcing their deal, right? And so, yeah, if you look, I mean, if you compare our first quarter, second quarter, third quarter, those numbers have gone up a little bit. And that's because we are seeing some inflation in different parts of the supply chain, but not materially. And I think to Paul's point, all sites are not created equal. And, our site is a great site. And that's why, our cost to build is what our cost to build is. So I think, based on our last slide, I think we guided 6 to 8 on a critical megawatt basis. And I think we're still comfortable with that.
Yeah. And Brett, the other thing is, as I indicated, listen, I'd love for Core42 to take as much capacity as they want here, but it is highly likely we'll have at least one customer, maybe two. And the customers may have design differences. Some may want more cooling in the building, some may want it to the rack. And that will drive the cost as well. So, we're in the range where we're very comfortable, telling the markets and our investors where we expect to be, but those are the drivers.
So when we think about additional deals, I think you guys have kind of like laid the framework for the unlevered yield with this deal that you guys are targeting. Is it safe to say like that's a good place for what we should assume for additional deals to be around that range?
Yeah.
Yeah. Look, we think that's a fantastic return for us and our shareholders. But as Paul mentioned, credit quality really matters, and the ability to lever that, right? And not only credit quality at the data hall level, but I think of, credit quality also a couple of years down the road, as Paul is mentioning, in diversity of customers, diversity of sites, right? I mean, we all come from the energy power patch, and the evolution of this space really reminds me a lot of Cheniere, right? If you think about Cheniere, right? I mean, I was at Blackstone when Sharif Suki said, we want to go the other way. And everybody thought that was crazy. And his first financing was at 17, 18% preferred stock. And then once Bechtel built the first train, they got it done. The project finance market saw it, they project financed it. Then once they built a couple of trains, they then started financing at the corporate level, right, at a much lower rate. So I think that evolution will be exactly the same for us. Our first financing will probably be at a higher rate than we would like, but then the next one will be a lot tighter, and then we'll ultimately get it to where we're financing ourselves just like, Equinix and Digital Bridge and Digital Realty and others, at the corporate level at 5-6%, right? That's the end game.
But I also would say, just to add on to that, and I don't want to get in front of ourselves here and say the terrible word REIT, but which is the most fabulous word on the planet. But at the end of the day, there is value. I think we actually set the bar really high with this transaction. It was led by Nazar and Patrick and Kerri, and there's a certain value into sort of doing it over again, right? Wash, rinse, and repeat. And there's a certain value as we look forward to the structure that will enable the highest yield to our shareholders in terms of a uniformity of transactions. So, I think this is where we want to be. It's where we said we wanted to be before we even got there. And I think, listen, if, anybody on this call, if you told them, hey, you can invest and get 17 unlevered return, they're there all day, right? I mean, they're there all day. So we're going to continue to make this format our format, and obviously we'll refine and be critical of the terms, depending upon the customer, but this is where we're headed.
On the leases, I think you guys started building out your buildings before you signed a lease. And how important is that to have a customer be able to come and see the buildings before they sign? And is that something that you would expect to, happen again, or is the fact that you've already got these buildings up and running like an important step for you guys to go out and sign additional customers?
I'll take that, Paul, and maybe you can jump in. I think it was critical, right? The customers, the big takeaway I think that everybody's seen in the market is that rapid deployment is the primary focus, right? And so having the ability to sort of see, touch, and feel, see the team, understand what's possible, and understand how the cooling technology works relative to the design, I think was important. And that's why we did the WULF Den when we did. Uniquely enough, we were going to even go a step further and buy a small amount of GPUs to operate ourselves in the WULF Den, so we would even have a better understanding. But very quickly, our customers said, hey, don't do that. We actually want that capacity, so please don't take that from us. And so I think having the buildings up and running, equity funding that on our own out of the gate was instrumental in getting the terms and the quality of customer that we were able to get. These things are highly customizable. So now that we're going to have WULF Den CB1, CB2 now beginning construction, WULF Den's already operational. Additional customers, we have ongoing negotiation now with additional tenants. Those things now aren't, we're up and running. And so I think there was a little bit of a chicken and egg at the very beginning, and we wanted to alleviate that, tension, if you will, by just equity funding things out of the gate and then taking out our equity once the buildings are up and running and producing revenue.
Yeah, I would add to that. When this group, we were in the power business together, and we built power plants for ourselves, but also for third parties. And it was really important to be able to demonstrate to a third party, not only that we knew how to do it, but to the standards that we did things and maintained and operated them. This relationship is critical. It's as critical for Core42 as it is for us. We got to build state-of-the-art facilities. We got to operate them best in class. And so having something that was up enabled the teams to coalesce. Nazar's teams, both technology and operations, it enabled them to meet on site with our customers' teams, with Dell's folks, and to problem solve or create, if you will, where we are and where we're headed. So it was very enabling. And I think it was the difference between us and many other folks who were promising that they could do what we said we could do, because we demonstrated that with boots on the ground and our infrastructure in place.
I think Core42 was, kind of looking at multiple potential parties. I guess what would you put down as the key reason why they decided to go with you?
Naz?
They've told us it's credibility, our ability to deliver on what we say we're going to do. And so they were I think they were able to see what we've done just kind of in the mining space and what we've done, our ability to procure power, our ability to procure power at scale and at a good cost. And so it was really just, the credibility and being able to deliver what we say we're going to do. And again, this gets back to this earlier question of, you're talking 20 megawatts, 40 megawatts, some folks said, hey, these are not big numbers. I think they're really big numbers. And when you think about, again, the total capital that's required to build these things out and actually populate them with hardware, these numbers are very significant. And so we've been very focused on delivering on what we say we're going to deliver. And I think that credibility really shone through, and it was why we kind of rose to the top of their list on counterparties that they wanted to work with and to be their first partner to build and scale with in the United States.
There's a gigantic difference between a term sheet or an option and all these big numbers that can happen years out to a signed contract with, prepay, sovereign credit support, finite demand requirement, and with timelines. So, Patrick has always been, from the day we got into Bitcoin mining, and now he's been as rigorous in high performance compute and AI. We announce everything on the back of what we've executed and what we deal certainty, if you will. So I think from that perspective, our customer was enamored, and of course, we're entirely enamored with them. They've been both throughout the negotiation, throughout the development. They have just been a class act in every respect.
Maybe a question for Pat. I guess you just made a question. How is the cost of power treated in the contract? Is it passed through? Cost on the call described as 2 buckets of costs, people and other insurance. I guess where is the power cost in the contract?
Yeah, the customer gets 2 bills from us. One is the lease expense that I mentioned, which again is 1.5 million per megawatt of revenue to begin with. So they get that bill, and then they get a energy bill, which is just a pure pass through. So they get the same price that we get for mining Bitcoin, they get for using GPUs. So they get 2 bills. One is the lease, which obviously is very predictable. The other is power. As folks know, power at our site fluctuates. We buy, grid power. Right now, power is higher because of and by the way, it's higher nationwide. Anybody that doesn't tell you that is lying, because you can pull up LMPs in Texas and see it down in Texas too. So December, January, February, power is actually quite high for all of us in the U.S. right now, given the polar vortex that the middle U.S. and eastern U.S. is experiencing. And then for us, the beauty, right, of being so close to Niagara Falls and also in a zone where there's 5,000 megawatts of power and on average 1,800 megawatts of demand is, come March through November, power, it tends to be really cheap. So they will get a pure pass through of power cost, same power cost that we realize for Bitcoin.
Got it. Helpful. I think, that probably goes through most of the questions that we had. Paul, maybe I'll turn it back over to you, with maybe just one final question. Like, what do you think the market is missing most, about this deal and option and kind of what it means for the future of WULF? I think it's, if you run the math on it, I think the deal creates a lot of equity value for shareholders. So just, what do you think the market's missing about this deal?
Listen, John and Patrick have handled, I don't know, 100+ phone calls since we announced the deal. And I think it was, a combination of the period when we announced the deal, and Core42 may not be a household name, but it is a unbelievable credit with the backing of G42 and G42's private investments. So I think it just took a little bit of time for people to get educated on who our customer is. That's one. I think the second thing is people don't understand size. And I think Nazar's tried to explain that in this call. These are big numbers we're talking about. And from our perspective, I guess we could have, we did not intentionally look to come out with some announcement for 500 megawatts to a hyperscaler. We wanted to be right where we are, the co-location space, 17% unlevered returns, top-notch credit, you know, somebody that shared a vision for how to develop the space, and we'll grow, you know, we'll grow building by building, 50 to 100 to 150 megawatts at a time. And so I just think it requires a little bit of education. We're grateful for your interest in the deal. And I think, you know, the proof is in the pudding, right? We're in a fortunate position right now. I understand some of our investors, they do think about the stock price. My job is to worry about the long-term sustainability and care of this business. We got a great customer. We're going to make a lot of money. We're going to provide a great service. They're going to be very happy. We're going to continue to grow with them. We're going to, you know, come up with another customer or two. We will grow with them, and we'll continue to, around the edges, be the most efficient financiers of our business when we think about structure, and it will provide the greatest return to our shareholders. So, you know, that's how we think about it, and we're all trying to avail ourselves to all the customers that we have, the shareholders that we have, to let them more fully understand the deal. But I think calls like this go a long way.
Awesome. Well, really appreciate you guys taking the time. Thank you, Paul. Thanks to TeraWulf team. Thanks for everybody who has joined. Really appreciate it and look forward to doing more of these in the future.
Thank you.
Thank you for having us. Bye.
Hey guys, Happy New Year.